Are you thinking about moving, but you haven't sold your current home yet? Whether you're downsizing, upgrading, or relocating, one of the smartest ways to fund your next move is by using the current equity you have in your current home. Today, my special guest, Stephanie Medlock from Benchmark Mortgage, will be joining me to share options for how you can use your existing equity to finance your next purchase without the stress. Stephanie is a wealth of knowledge. She has over 2 decades of experience as a loan officer, and she is our team's go-to recommended lender here locally in the Charleston, South Carolina area. Now, Stephanie is licensed not just in the state of South Carolina, but in 7 states total. So she can potentially help you even if you are not living here in South Carolina. We are going to be talking today about bridge loans, HELOCs, cash out refinances, and so much more. So stick around. By the way, I'm Sarah Newman. I am a realtor and team leader here of the Elevate team with eXp Realty. And we love helping people just like you make your smooth move to Charleston or help you with selling your home here in the Charleston and Summerville area if you are local to this market. If we can be of service to you, we would absolutely be honored to have a consultation and guide you in the next steps. All of our contact information is pinned below in the comments and the description, as well as Stephanie's information. Without further ado, we're going to get right into the conversation about how to strategically use your equity. Thank you so much for joining us today, Stephanie. I'm really excited to have you here on the channel, and you will get to share so much of your lending expertise with our audience. I know that one of the issues you and I both run into with our clients is how do people purchase their next home? So a lot of our clients already own a home, whether it's in South Carolina or another state, and they are so excited to move here and to buy their next home. They've got all this equity sitting in their current home, and then the conundrum is now, how do I get under contract for the next home, especially without a home sale contingency? So today we're going to talk about using your equity, and whether you're retiring and downsizing, whether you're upgrading your home, it can apply to a variety of situations, but I'd love for you to share with us everything you know about using your current equity.
Yeah, absolutely. So I'm happy to share. So as you guys know, we live in the beautiful city of Charleston, South Carolina. So we have a lot of people moving here and a lot of people are sitting on a ton of equity. So one of the things Sarah and I always advise our clients is, prior to moving, always get pre-approved, right? And one of those things is always going to be making sure that you're possibly tapping into your current home, because like Sarah mentioned, in our area, contingency offers, although accepted, they're not like the most favorite, because obviously if you have a home to sell. So what we try to advise our clients is, believe it or not, people right now are sitting on about 72% of equity on a national basis in their home. So imagine the nest egg that you're sitting on and living on right now, and you can tap into that equity. And there's a couple of different ways we do that. So the first being a home equity line of credit. So that is going to be the absolute cheapest route, and I'll go into a little bit more detail on that. And then the second one is doing a cash out refinance. And obviously, a cash out refinance is great. And the loan amount's normally bigger, but you're refinancing the entire mortgage. So let's say that you had a really good rate when the COVID years happened and we had these historically low rates in the threes, and you don't want to refinance that mortgage if you intend to keep it or sell it, obviously. But if you refinance your entire mortgage, now your entire payment is higher. So that's why we like the home equity line of credit. It's cheaper to get one. As far as closing costs, they're quicker to close on. And then the cash out refinance is more expensive. And then the third option is going to be a bridge loan, which are the standard loans that were popular back in the 70s and 80s that our parents used. And those have now come back again for the bridge. So there's a couple of different options out there for everybody. And what we like to do is make sure you're structuring it the right way in the very beginning when you get started.
Yeah, and that's why I recommend to people to really talk to a lender months before they're even really considering getting started if they know they want to make this transition. Because if you're going to do something like, I mean, really any of these programs, but like a HELOC, you want to do that well in advance of getting your home listed or making the move and having the financials in place and making sure that all of the ratios work and everything. So
Yes.
you want to talk about when you would use, so there's HELOC, bridge loan, and the cash out refinance that we're talking about today, and really wanted to help people get clear on which scenarios make sense for them. And you talked about some of the downsides of the cash out refinance option. So if somebody is sitting with a 3% rate from COVID days, that's probably not a good option for them.
Right.
When would that be a good option for somebody? Like, when would that be the most preferred of the three?
Yeah, so when you do the home equity line of credit, there's a couple of things to consider here. If you do the cash out or the home equity line of credit, you want to make sure to talk to a lender first, because if you pull money out from your home, either way, through a cash out refinance or home equity. So let's start with a home equity line of credit. Most of your home equity line lenders are not going to lend on a property once you have it listed, because that's a short-term loan for them. They're not going to make money overall on that. So when you call them, you definitely don't want to say, hey, I'm about to sell my house. You just want to say, hey, I'm calling to get a home equity line of credit on my house. You can always, when you're moving, you're always doing like repairs to the home and getting it, maybe updating something before you put it on the market. So you want to do that in ahead of trying to buy the home here, because what you don't want to do is get a home equity line of credit and go draw, let's say, $200,000 off of a home equity line, because now we're going to have to count that payment against you. So really think of it this way. A home equity line of credit, you can line up. It's not like a 30-year fixed mortgage. So let's say you had $300,000 equity in your home. You do not want to go and try to take all of that. Obviously, they typically limit you to about 90% of the home's worth anyway, to allow for room for when you sell your property one day to pay agent commission fees, seller pay, close, all the stuff that you've got to do when you sell a home. So you always want to line it up for as much as you can, but you want to advice from your lender, because you don't want to have a payment, because now if you have a new liability, we have to count that new liability against you on the home you're purchasing here in Charleston. So be very careful about how much you pull out. And let's say a lot of times clients, they get a little nervous about making payments on their existing home, let's say in Colorado, and then they're taking a second lien mortgage out for their next purchase. So now they have two payments associated with that home, and then they have moving expenses, and then you're putting a down payment and closing costs. So what I always advise people, take the minimum amount out you need for the down payment and closing cost, leave the additional money on the home equity line of credit so it's available to you to pull out. Imagine like a credit card, you have checks that come with it so you can write it as you need it. And then when your mortgage payment comes for your house in Colorado, you can just write a check from your home equity line. That way, each month, your balance is slightly going up on how much you owe, and your payment might adjust a little bit, but you're not initially just pulling out, let's say, that full, amount out, where now you might have an issue qualifying for the loan. The cash out refinance, it could be an option. We don't really go to the cash out refinance very often, because typically cash out refinances are limited to an 80% loan to value. Now, right now, people, like I mentioned, are sitting on a record amount of equity. So typically that's not an issue. But with a home equity line of credit, you're normally allowed to go up to a 90% loan to value. So just to give you a super easy example, if you had a $100,000 home, you could borrow up to $90,000. On a cash out refinance, you would be limited to $80,000. Does that make sense?
It does, yes. So that illustrates the point of wanting to talk to a lender early on again. If you wait too long, then you're saying that, well, one, you can't do it too close to listing your home because you won't get the HELOC, right? And then two, that you can mess up some of the ratios and the things that you would needing to qualify for your next purchase.
Yes, because, and that's where a bridge loan would come in on that third option. Is the bridge loans are wonderful, but they are really for the perfect person. So you have to have obviously a ton of equity in your house, which most people do have, but they tend to be very expensive. So it's like a full other closing cost. So, instead of spending maybe, let's say, less than $1,000 to get a home equity line of credit, If you do a bridge loan, you have the whole, the whole thing. So it could be with their additional fees that they charge, it could be upwards of, on a $400,000 property, you might be looking at paying like $15,000 to $20,000 in closing costs. And so that's obviously your last resort, but it's a great go-to option when, let's say, your house is already listed and it's too late because you didn't know that you could do that prior. That would be a good reason to use a bridge loan.
Would there be any other reasons to use a bridge loan other than that timing?
The bridge loan sometimes just makes people feel more comfortable while you're in the process, so you don't have two payments on each house. And so that could be a reason why people use the bridge loan. But honestly, like, we started doing bridge loans about 2 or 3 years ago again. And every time I run it by a client, they tend to just go back into either the cash out refinance or the home equity line of credit after they hear the amount of cost. Because, you have to think about what your bottom, net price is. And obviously when you're moving here, you have a lot of expenses. So people tend to like kind of shy away from the bridge program unless it's absolutely necessary.
Mm-hmm. That makes sense. And then what about renting the home out? So let's say somebody wants to move and perhaps rent their current home out for a few years because they're still attached, or maybe they want to try out South Carolina, but it doesn't work out. They still want to have their place on Long Island just in case, so whatever the scenario might be. So can you tell us a little bit about how people who want to hang on to their existing residence could still move forward in their next home?
Yeah, and that's a great point, Sarah, because a lot of times, like, I'm dealing with a client right now that they just bought their home a year ago, and now she's getting relocated here due to her job. And so, she obviously doesn't have a ton of equity based on the program she initially did. And so that could be a reason, like, for that particular example, like, you could rent out the property versus having to go ahead and sell it when you don't have a ton of equity, because then you might be coming to closing to pay, agent commission fees, seller paid closing costs, anything that you have to do in order to sell the property. You might have to bring cash to closing, right? And so, and then some people, like you said, I mean, how often have we, someone's moved here and they don't, maybe they don't like it. I don't know a lot of people that haven't liked Charleston. I think I've only met one or two ever in 23 years, but it gives them the option of moving back. Or, for example, a lot of veterans are on PCS orders. They're just relocating here, and that's their home base. That's where they know they want to take their family back home to. And so that's a really fantastic option for people that are just really uncertain. And also, it's a great way to utilize and build wealth by having two buckets of real estate going versus just the one. So now you have the property over here making you money and the one here in Charleston. And the cool thing about it is all you really have to do is get a signed lease agreement. Normally get the first month's check for the first month's rent and a security deposit. You show those three items and you can basically wash out most of the times if you're in a pretty decent rental market. The way it works is if you have a rental income of $2,000, they're going to let us use 75% of that because they assume the other 25% is going to be, going towards things to help the house. If you have something that's damaged and you have to bring that, they allow us to use 75%. So in that example, if you rented it for $2,000, they would allow us to use $1,500 to offset the payment. And 95% of the time, that's enough for us to wash it. We just can't use any positive income to help you qualify. So if you're making $4,000 in real income and your payment's only $1,500, we can normally only exclude the $1,500 mortgage payment, not to help you qualify for your next loan. And then sometimes too, Sarah, on VA loans particularly, they do allow for a rent analysis provided by a local real estate agent instead of having to run around and find someone to rent your house, like let's say last minute, or let's say you can't rent it out for as much as you really want and you don't want to be pushed into renting something for a year for lesser rental income just to get it leased. In some cases, you can get a market analysis done from a real estate agent, which is super awesome too.
Okay. It's good to have options and different ideas. So are there any common mistakes that you see people make when it comes to getting a HELOC? I know we talked about some of the stuff already, but is there anything else that you would add that you see oh, if someone had only known XYZ, then they could have made this work, but now they don't qualify. Anything like that that people should know for any of these scenarios that we're talking about today?
Yeah, I think the main thing is people need to understand that you have to be comfortable with making several payments, right? Because obviously, that's why I always advise people. The worst mistake I ever saw was a client that wanted to have a very low mortgage payment here in Charleston. So she decided to go get the max amount of her home equity line of credit. She pulled it out before I had a chance to speak to her. So she had pulled out $400,000 and had access to that. She'd put it in her savings account for the down payment. The problem is now she could not qualify with a $400,000 down payment. So, we had to advise her to take that back and pay down the credit line. Because again, you don't want to borrow so much that it's going to cause an issue with qualifying for the mortgage here. And what she could have easily done instead was just pull out, let's say, the minimum amount down it takes her to qualify on the house here. So instead of pulling, let's say, 400,000, take 100,000 out. And then when that home sells, the cool thing is if you have, let's say, $300,000 left when you sell after, everything's all said and done, you can take that $300,000 and reapply it and do what's called a recast mortgage, which is pretty much every servicer in America, even if your loan gets sold after, someone's closed it, because that's how banks make their money. You can actually do a recast for a pretty small fee, normally about $500 to $700, and they will re-amortize that payment. So now you're at the lower payment that you originally wanted, but you were able to still buy both homes at the same time without, maxing out your HELOC or your home equity line of credit to the max amount, which caused an issue in her case.
Mm-hmm. I've had
Yeah.
quite a few clients do the recast in the last few years, I would say, that they wanted to not move twice, so they hung on to their old house. A lot of them are maybe building new construction here, for example. That can be tricky because you also don't know the exact timeline that the house is going to be ready. So trying to line up the sale of a home and your new purchase can be quite the art. So they'll instead either get something like we're talking about today, or maybe they've lived in their home so long that and their mortgage is so low they can qualify for both mortgages just on their own. But their ultimate goal is once their home that they're in now sells, they're just going to put down the bulk of those proceeds into this new purchase and just recast the loan within the next couple of months after they close. And so that really affords them the flexibility to make a smooth transition.
Yeah, and absolutely. And another thing too, you were talking about people that are doing new construction. A lot of times, a lot, you can sometimes have 6 to 9 months for more things to appear and happen. Like somebody's car might need repair, so they go get a new car, which now causes an issue. You can also use that home equity line of credit to pay down debt. So sometimes, if people have 4 or 5 credit cards, as well as I do, the interest on those are really high. So you could take advantage of having the home equity line of credit, which is normally prime plus a margin. So let's just say, to be on the safe side, 8% total. But that's better than, if you have a high interest credit card that's 25%, we could use the home equity line of credit to pay off debt, even if they don't need it for the down payment on the new house. Sometimes people, especially during COVID and inflation years, people did rack up a ton of credit card debt and liabilities. So you could access that home equity line of credit. And instead of having, let's say, 5 payments each month that are over $2,500 a month minimum payments, now you just have one reduced home equity line of credit for like $700. So I have utilized the home equity line of credit, not even so much for the down payment, but just to pay off debt so that it can help them qualify for the house here.
Yeah, that makes a lot of sense. And such a smart way to utilize it. Again, this is why you talk to a lender, someone like you that has this experience, because you can look at all of this for them. You're not just siloed into focusing on the home loans. You're looking at their credit and all of their obligations and really thinking strategically about how they can use these funds to make their entire financial picture stronger and better for them in the long term. So if people listening, if you're out there and you don't have a lender that is doing this for you, then you definitely need to get with somebody that can play this, it's like a chess game, right? Trying to see the immediate moves and the
Yep.
future. And you're so good at that. And you've helped so many of my clients make these types of decisions and really advise them, just be that trusted advisor that they know they can rely on to help them work through this puzzle. So thank you for all that you've done.
Oh, you were so
And
welcome. And you do such a great job at it. I mean, honestly, like by the time I get to them, they already kind of have had the mini loan officer talk because you kind of already know, like, hey, you're probably going to need to do these things. And then you send them my way. But I think it's so important to work with an agent and lender together cohesively because, you know, we're all working towards the same goal here. And when you are moving, it's already stressful. And this should be a process that's fun and exciting. And there's a lot of things we can do and advise you to do prior to so that it alleviates a lot of these concerns and issues that come up later. So, but yeah, so thank you so much, Sarah. You're so sweet.
well, absolutely. I've loved working with you. And I wanted to ask before we wrap up, is there anything else that we didn't cover on this particular topic that you want to make sure people have knowledge of?
I don't think in most cases I think we covered pretty much the cash out, the home equity line of credit. And again, it's all about timing because if you like for example, if you're not moving for, let's say it's just a thought right now and you're not moving for a year. A lot of times people want to wait, but we can do a soft inquiry right now that is literally like nothing happened. It's just cost me money to pull a credit report, which I don't charge. And so my advice, wrapping up this all, when you're relocating, retiring, whatever here, you want to make sure to stay ahead of the game because the thing I always see the most is people wait too long. And there was something they could have done 3 months ago, but now it's too late. And so my advice is to really just figure out what all of your options are. Maybe it is leasing your property and keeping it. And maybe it is getting a home equity line or taking the full cash out refinance. So it's really it's honestly everybody's situation. I have not seen one person's credit profile and income situation that matches anybody else's. So it's really a case by case basis for every single client on what fits for your style and your needs and what you're comfortable with. Some people are scared to death of home equity lines of credit, and that's okay. If that's not your thing, like we can find other ways to make you more comfortable with buying the next house here, just trying to set you up for, because Sarah, I know you see it a lot with contingency offers. I mean, I had one of my clients get denied today and they lost their house that they really want because, they do have a contingency sell and they're not willing to tap into that equity. But and that's okay. That was their decision. But we just want to make sure if that perfect house comes on the market, like I'd mentioned, we can pull credit now in today's world and it does no harm to your credit. And we can look behind the scenes and tell you now, like, hey, here are your options before your move next year. But it's good to know that now because recently her and I also had a client that also kind of waited. We've been talking like since back in January and now they're coming in town this weekend. And now, that's posing a little bit of an issue with the tax returns, which we'll go into on on one of our videos coming up. But it's just important to start early.
Yeah, absolutely. I think a lot of people have maybe a fear of talking to a lender because they feel like they're going to get judged. Maybe they have some shame around their credit card debt or whatever it might be. And so they try to keep it close to the chest until they absolutely find the house they love. And then they're scrambling last minute to try to get this pre. But if you had just opened up earlier and had this plan and know, oh, actually, I could just pay that down in the next few months and then my credit would go up and I can qualify for this next level. And you just have this plan in place. It's just so much smoother and less stressful to do it that way. So I always encourage people, like to your point, just to do it early on and not wait, and just know that if you're working with the right professional, that there is no shame in the game. You're not there to judge them or to make them feel bad about anything. You're there to objectively look at all the information and just guide them on the best path forward. And that's really all that it is. They don't have to be scared of the conversation.
Oh yeah, absolutely. Because I think what's more terrifying is the unknown. It causes more anxiety and more fear when you want to make a move, but you don't really know how to get there. And I've found that once clients do speak to us, we really make them feel confident and better about what their options are. And they're really working with what we know is going to work versus maybe I can make this work, or maybe I can pull money from here and do it here. And then only to come find out you can't. So, I think not knowing is more stressful than just, and honestly, we look at so many bank statements, guys. I wouldn't even know what anybody spends their money on. And I know it's kind of like a scary thing, but it's one that has to be done. And so I say, rip the Band-Aid off and get it done as quickly as you can.
For sure. And a lot of clients too now with ChatGPT, which you and I both use and love, they're trying to figure
Yes,
it all out with chat. And I talk to clients like, oh, well, chat told me I could do this or do that. And I'm like, well, that's a good start. I'm glad you're learning, educating yourself. But at the end of the day, you really have to talk to a human loan officer who is going to be the one issuing the loan. So you really, you can't trust everything that you see with AI and online. You have to make sure that you're actually talking to a qualified person.
absolutely.
Well, thank you so much for being here today. This was really wonderful. And I'll have all of your contact information, of course, pinned in the description where people can reach you. And of course, people can always reach out to me too. And I'm happy to connect you all and get you squared away. So thanks for lending all your expertise. And we'll see you in the next video.